Hey, good morning, Facebook. What's going on? My name is Kirk Bowman from Art of Value. With me is my colleague Hector Garcia from Quick Bookkeeping, and we're back with our weekly show. Today's topic, we're going to talk about something that really grew out of the conversation we had last week. You may remember that 2 weeks ago, Hector raised this issue of an accountant remaining independent. And so last week, we really dove headfirst into that topic. We talked about what does independence mean? What are the two things that really drive independence, primarily audits and taxes? And I raised the question near the end of the episode last week. I said, well, what did accountants do before taxes? Because it seems like, the IRS, which came around in the 1930s as a result of the U.S. income tax, kind of has taken over the accounting profession. And as you know, we're advocating you need to be an advisor. You really need to be a consultant to your customers. That tax is only a small part of what you do. And so I raised the question, well, what did accountants do before all this compliance work? And so my colleague Hector has done that research. So Hector, what did accountants do before the IRS came into being?
Yeah, that's actually a great question. So, yes, welcome everyone to the Art of Advisory. And what we want in a nutshell is to make the case that advisors are going to be best off in terms of the value they bring to their clients and in terms of creating sustainability in our industry if we change or shift from compliance to advisory level services. And one of the discussions we've had for the last 2 weeks is, what are the challenges or the reasons why a lot of us are afraid to get out of this independent status because we lose a lot of the particulars around what accountants are quote unquote supposed to be doing. Now, let me take you back a little bit of history. After the Civil War, so we're talking about the 1860s, all the way to the 1920s, there was an explosion in industry in the United States. One of the largest, most prevalent industries that make the books in terms of what people study in terms of explosion is the American railroad industry and the steel industry, right? Led by Andrew Carnegie and Rockefeller and all those guys. What accountants started to be extremely useful for during that explosion is for resource planning. Now remember, the IRS didn't pass a code where there was federal income taxes until 1913. Now there always had been taxation in the states. The states had their own version of sales tax, tariffs, import tax, in some cases consumption tax and stuff like that. But there never was a federal income tax, something that every accountant in the United States could work. In essence, every accountant in each state had to know the laws for each state. So we had a very long time in which there was a huge need for accountants, and the need for an accountant was mostly for twofold. One is called cost accounting, which is a dying breed actually, and I'm going to dig deep into that. And the other one is resource planning. And resource planning really has been the one that has evolved and become today's hottest thing to do as an accountant, resource planning. And but at its core, it used to be cost accounting. So let me explain. Let's go back in time, and we're building a railroad from New York to San Francisco, from New York to Los Angeles. So we're linking two huge cities, and we want to obviously link the two with railroads, which takes a lot of steel and it takes a lot of labor, right? For the most part, let's just assume that building a railroad the foundation is building the track itself, and it's pretty much steel, wood, and labor. Let's just assume that. Okay, so we have a whole bunch of accountants that are hired to figure out how much of those resources we would need to put together or pull together in order to be able to finish this track, let's say in a year time span. So they get together all the engineers, all the construction people, and say, look, we have a year deadline to build a railroad track from New York to Los Angeles. How much progress would I have to make, let's say in a weekly or in a monthly basis for me to get there? So everybody starts crunching numbers, and they go back to the accountant and say, well, it looks like we have to build 100 miles per month, whatever it happens to be, right? 1,000 miles per month, whatever it happens to be. So then we'll break it down into, okay, how many units of labor, how many employees, how much steel, how much wood, How much supplies do I need to get there? And in essence, they build manually by hand this this spreadsheet, right? That basically tells you everything that you need to buy, stock, purchase, and people you have to hire in order to build this. That is one of the most important things that accountants did. But then it got a little bit more complicated because we have folks that live in New York that we can hire to build the railroad track all the way up to getting to New York City. So that's something that we could do. We can build the entire railroad track coming to New York City. There's my son coming in and interrupting. I feel like you remember the guy from BBC that was doing an interview about North Korea, and the kids came in and the wife came. That was kind of that episode, which is perfect. Anyway, so so one of the challenges is, okay, so we have to make some major decisions about the cost element of this. So do we hire our entire construction crew from New York City, right? And then do we move them, travel them, and lodge them along the way as we build this railroad track? Or do we hire the entire crew from Los Angeles who could have a different cost rate? It could also have different effectiveness in terms of how quick they work. And do we bring them down and then we move them down? Or do we hire a mixture of employees between New York and Los Angeles and maybe somewhere in the middle? So that's one concept. Second concept is, where do we get the supplies from? Do we buy them all from New York? Do we buy them all from California? Do we mix, where we get all the steel and the supplies from? And how much of it do we need to stock or have? And how much does it cost to bring it on site if I bring them in little pieces or if I bring them in large shipments? So that was essentially what accountants did, which is an extremely useful function, which is do the entire resource planning of this. Now, the other piece that accountants did was help these people price the job. Now, in some cases, the government was paying for some of this work. In some cases, it's private industry. At the end of the day, they need to figure out how much to charge, for a railroad trip, or how many trips you would have to make back and forth with cargo, charging X amount per pound in order to get your return on investment. All this stuff encompasses something called cost accounting. And that was the other major function of accountants. So that is the two places where accountants lived for the most part. Major cost accounting for sort of manufacturing, labor, materials, and also enterprise resource planning, which is making a decision of what to buy, when to buy, how much to stock, where to source things from. Now, that sounds like an amazing profession, right, Kirk? I mean, doesn't that sound like pretty much, the end-all be-all of useful people for a small business?
Oh my gosh, the first thing that goes through my head is but the second thing that went through my head is there's actually a really good TV series that came out, and I forget, I should have looked it up, but it was just in the last few years, called The Men Who Built America. It was either on the History Channel or created by the History Channel, and it was based on kind of 5 pillars of American industry that are in the area you're talking about. It's really kind of post-Civil War up to between World War I and World War II. And so the series talked about people like Cornelius Vanderbilt, who really was the one who gave the railroads, kind of the first one to really get after it as an industry and so forth. And then, of course, you had other people like Carnegie, who you mentioned, the steel industry. You had Rockefeller, who, got into oil, kerosene, J.P. Morgan, and Henry Ford. And so the series focuses around these 5 individuals and some of the other people they competed with. And so it's during this era that you're talking about, the Industrial Revolution, that these types of functions for accounting, resource planning, and cost accounting came into being. While that's where the history is, what's interesting is that we're now in a totally different era. We're like 2 away from that, okay? And yet a lot of accountants are still acting like they're rooted in that era. So on the one hand, it's good to go back and look at where you came from because it has had substantial influence. But at this point, I would say by looking back, it helps ask the question, okay, well, if we're trying to move away from compliance, then what did accountants do before compliance? And I would say they really served as advisors. They served as consultants. They did resource planning. cost accounting, I think effective cost accounting, and this may be a whole separate show, but in my mind, the best cost accounting is you determine what you first determine the price you're going to sell something at, and then you make sure your costs fit within that price structure. So, rather than chasing the costs, you dictate what your costs are in advance. And it's interesting, we do the same thing with time, right? When we record, and I say I don't track time, right? And you don't either, but many people in the profession do. And so when we track time, we're essentially, thinking that we're cost accounting, and we're not. If you want to do something like that, then use the term you used, resource planning. Okay. Plan your week out in advance. Say, okay, these are the things I need to accomplish. These are the priorities. And so I'm going to dedicate a half day to this. And I know every week I've got to spend at least 4 hours on marketing. So I'm going to do 2 hours on Tuesday. That type of resource planning is really what we're talking about. And so it's kind of interesting. We come full circle in my view. Accountants were consultants before, taxes and compliance took over. And now we're saying, get back to it.
Yeah. And I think we should probably dedicate a whole episode to cost accounting, just because my mind has changed a lot in the last 5 years about what cost accounting is and the role that it has in our profession. But cost accounting was I just got to tell you, it was the exciting part of college when it came to accounting, and exciting in quotes, right, for accountants. It was the exciting piece because it was the place where we see the mechanics of the entire spectrum of the business be put into play in numbers, like labor hours and availability and capacity and usage and waste. And as accountants, we get excited about using those numbers and turning into something quote unquote functional, like a margin, gross margin, and a price. Now, in the last couple of years, my mind has changed because I believe pricing, it's about so many other things than the cost. Although the cost, I still believe it does play a little role in it, but at the end of the day, price is actually not related to cost at all. So I think we will dedicate an entire episode to that because it should, but I don't want to mix things up. I want to go back to resource planning. So in that scenario where I told you accountants play these two roles, where maybe they were the cost accountants helping people price and make the margin or the profit that they want. In other places, they were more operative and doing some resource planning. But what happened, to go back to history a little bit, in 1913, the IRS passes the 16th Amendment, and then it gives the U.S. government the capacity to tax people in a federal level. In 1934, the Securities and Exchange Act came into play that started to build regulations around what accountants are supposed to or not supposed to do when issuing financial statements to the public, because the U.S. government wanted to protect, quote unquote, the consumer, and they wanted to create, let's call it, a healthy stock market, capital market for people to invest capital. And in many ways, there's a lot of positives that have come from there. I mean, the availability of capital has helped some of these companies flourish and invest and take risks. And the investors know, and they've done a pretty good job at knowing and understanding the risk they take. Where the government kind of butts in a little bit is setting the regulation of what the accountant is supposed to do before they say, yes, you can issue these financial statements. And I'm not completely in disagreement with it. I'm a little bit of an anarchist in some cases, because I believe the government in some cases does more harm than good. But for the general public interest, the Securities and Exchange Act has done a pretty good job, at least on standardizing the processes, so people have some faith on these financial statements that are being built. But it was during this time, in the 1910s and 1930s, where accountants got shifted from their original role of either cost accounting or resource planning into both of these areas of compliance. Now, I want to fast forward to today. Today's industry doesn't look anything like yesterday's industry. I would say 100 years ago, however long the industrial revolution was at its peak, there was two major pieces of input. We had raw materials and we had labor. And conceptually speaking, every business owner and every cost accountant thought that all value came from, this input of materials and this input of labor. Now we're dealing with the information age. We're dealing with a time where Facebook is one of the most powerful companies in the world, and there's absolutely no input in materials. And you could argue that there's some input in labor, but it's all creative labor. It's not labor that builds anything. It's just people writing code, right? So in today's age, where we have Google, one of the most powerful companies in the world, where they essentially sell information, I don't think anyone during the industrial evolution foresaw anything other than industry as being the main driver of value to the business world. Now, all of a sudden, it's more about information. It's more about the speed in which you find, deliver, decode, and cater that information. And it's all about your capacity to curate massive amounts of information. And that's really where industry is moving to. So we can no longer use the inputs of the past, like labor and materials, aka cost accounting, to determine the value of the future or the value that we bring to the present. So I think we need to go back to the history in which we were both resource planners and cost accountants, possibly put cost accounting to rest, or maybe understand its roots and the basic elements of it. I probably wouldn't want to eliminate cost accounting from college teachings or college training, just because it does really make you understand the function of numbers in a business. But it does definitely has to be removed from pricing, right? Or from marketing, or from the value that the product and the service brings. But our job right now is to evolve and become amazing resource planners, because accountants forever, or especially since all the regulation, Income Tax and Security Exchange Commission Act, for a very long time, our role was to be very accurate historians. And very accurate historians have an important role, but they don't impact small business owners as much. They don't impact industry and commerce as much, right? Because historians, all they do is tell you what happened. And I don't think any accountant should also play the role of Nostradamus. Like, no one should be trying to predict the future. So I'm not also advocating that you should predict the future. But what accountants need to do is ditch the piece where our role is historian, also ditch the piece where we try to predict the future, and we focus on how we help people shoulder to shoulder, hand by hand, equal mindset, run their business forward and act and react to the things that are happening that are beyond accounting, beyond costs, right? That's resource planning. That's planning for tomorrow, right? Or making the assumption, right? All resource planning is making the assumption that tomorrow will go as planned. But if you're permanently there, and you're always with the mindset of resource planning, when tomorrow doesn't go as planned, then your job is to shift whatever you have to shift to then make the next tomorrow go as planned. And it becomes an never-ending cycle. So if we, as accountants, focus on that piece, and obviously we have conversations around what that looks like, I believe that's the place where we can add the most amount of value. And at the same time, we can also get rewarded for that value that we bring as well.
So would you agree that resource planning is one of the areas where accountants now can actually assume the same role they assumed, over 100 years ago, step back into that may be one of the most valuable things they can offer their customers? Because resource planning is that idea of saying, okay, resources aren't limited. How do we create a plan that uses those resources in the best way possible to maximize our return on those resources? Because every business has limits on the resources available. Those resources can be cash in the bank. They can be credit available from the creditors. It could be raw materials. It could be finished goods inventory. It can be talent. I try to steer away from the word labor, because nowadays it's more about talent. It could be the information available in people's heads. There's all types of things that are those resources. And so accountants can help businesses plan. One of the reasons I think that's so valuable is just because you cannot see the label on the bottle when you're inside the bottle. What I mean by that is, when you're the owner of a business, you can't see things with an objective perspective. You cannot see it with the same set of eyes that an accountant can, for at least two reasons. One, the one I just mentioned, the accountant is outside the business and therefore brings an objective third-party point of view. Also, the accountant is not tied emotionally to the business as well. That's also part of having that outside view rather than that inside view. But the other part of it is accountants work with multiple business owners. Ideally, the really good accountants that specialize, maybe you specialize in real estate. Well, you've worked with several people in the real estate business. So not only do you bring that objective viewpoint, but you bring the expertise of having worked with multiple people in the real estate industry in an objective capacity. And it's that type of insight that I think accountants bring to the table that's most valuable. And resource planning is simply one of the areas where you can exercise that insight. Yet, as we talked about, because of the history of, as you said, what was it, 1913?
1913.
Because, that, and by the way, just as an aside, this series I mentioned, The Men Who Built America, it was on the History Channel. It is available on DVD. I think it's like $15 on Amazon. I think it's worth watching. It's about 8 hours of content. But a lot of the compliance stuff that the government moved to enact came out of some of the misbehavior from some of these giants of industry. And so it's interesting, because of misbehavior in capitalism, government stepped in and said, okay, somebody's got to monitor this and make sure that people are, behaving appropriately, not doing things that are wrong or unethical or against the law. And so this compliance piece came into it. But what's happened is that pendulum swung way too far. Okay, the compliance pendulum's gone so far that now it pulled the whole accounting industry into compliance. And what we're doing now is it's literally a reaction to that. Okay, it's really a counter reaction. If you consider that first you had the Industrial Revolution, then government steps in to fight monopoly and other practices that they considered to be harmful, pulled the industry into compliance, and now we're part of a movement that says, you know what, we need to pull back from that.
Yeah, one of the, you're absolutely right, Kirk, and I'll take your recommendation. I'll watch that series. I haven't seen it, but one of the most important things is, what is the definition of a business? The definition of a business is, well, I don't know what the textbook definition is, but my definition is you risk your capital and you hope to get a reward. And that's it. And I think the word risk is the single most important part of conceptualizing the meaning of business. Now, what accountants do, it's help give the business owner, let's call it calculated risks. And that's what the business owner really wants. They want the calculated risk of making a decision. When the accountants work on the inside, so if I'm a full-time accountant in a small business, and my CEO, the business owner, comes to me and says, help me make this calculated risk, the calculated risk of expanding a product line or expanding to a different state or country. Because I have so much stake in there, I am probably going to be biased to give advice that gives me job security. Unfortunately, that's one of the challenges. When I'm an outside accountant and I have multiple clients, and this goes back to the conversation of independence a little bit. So there is some value on the whole independence concept. So I don't want to go back to that conversation, but there's some, and we're independent. We don't have that much at stake. So if we tell our client what our opinion is, our opinion doesn't come attached to any fear of risking job security or something like that. But back to your point, the industry flourished, and what I call industry, I mean the job security to external accountants, flourished so much under the Security Exchange Act of 1934 and under the income tax that basically government and compliance was the one that gave us the job security. So we have turned into such a conservative bunch. And look, I don't think there's generally an issue with being conservative from a business perspective. I think it's good to be prudent. It's excellent to be prudent. But your reward is usually as big, or your potential reward is as big as your potential risk. So our industry has moved so much into the conservative, no risk, all compliance, goody two shoes, do good only, don't help your client take any risks. And we build a reputation around being that we forget, where we can add the most value. Yes, I think that warning someone that they're about to fall off a cliff has a whole bunch of value, because the only way you can keep talking to them is they have to be alive. So our clients have to be open for business. They cannot be bankrupt. Otherwise, we can't charge for our services. We know that, right? So we want to help our clients at least stay open and have a going concern. But at the same time, where clients are willing to pay the most is when you are comfortable with getting out of that comfort zone, taking off the objective, conservative, independent hat, and saying, what would I do if I was the business owner? What would I do if I was this person's partner? Using all that accounting knowledge, even using that conservative approach, and bringing to the table your observations with other businesses and all that stuff, and try to step a little bit outside of that compliance zone and forget about job security. I believe that when we have fear of losing our job, we always act different. I think we act different. I think we're way too prudent. I think we're way too careful, and we don't take enough risks, or the risks are so calculated that they're not risks at all. When we forget about job security and we say what we want to say, we say what's on our minds, we do what we feel we should do. Yes, there's a risk that we can lose it, but I believe the reward is much bigger than that. And that, in essence, I think, is how we are going to evolve our profession, by maybe not moving the entire profession, because we may still auditors, we need tax preparers. I think we still need those people. But there's going to be a shift in the way robotics and artificial intelligence and computer and technology moves, whereas we are only going to be needed most pulling back to be resource planners rather than to be compliance officers.
Probably one of the most important concepts that you just mentioned is the idea of risk, right? And when I think of risk, I always go back to what Drucker said. Drucker said that profit comes from risk. Yet you mentioned that accountants now tend to be a fairly conservative bunch. And so here we are talking about, okay, you're conservative by nature, but you need to learn to take risk. And one of the risks is you need to offer your opinion to your customers and be willing to back it up. Be willing to say, look, I think this is an area where I think the business is going to run off the rails, or here's an opportunity that you're not seeing and you're not seizing. Business owners want to make a profit. They know subconsciously that involves taking risk, but we want it to be calculated risks that we have considered both sides, and we decided this is the one worth pursuing. And you want accountants to do the same thing. Guess what? How do you get better at helping clients make decisions about risk? You help your clients make decisions about risk. Are you going to be right on everyone? No. But guess what? You're probably going to, just by instinct, start off in areas that are not as risky. You do that for 2 or 3 years, you're going to, by instinct, gain confidence and be able to take more risk as you're moving forward. So it's kind of this chicken and the egg concept of, you're conservative. How do you break out of that? You've got to take more risk. How do you take more risk? You take more risk. It's just, you get more comfortable with it. I'm trying to remember the context, and I can't off the top of my head. Oh, yes, I can. It was one of the interviews I did on my show. So trying to remember Jeff Carr. Jeff Carr was general counsel. So he was the chief attorney inside the organization. And he was a chief general counsel at FMC Technologies, and they're involved in a variety of things. But one of the things they make are submersibles. So you ever seen the undersea shows where they're, going down a mile or whatever, and they're going to, see what lives down there. Oh, a fish we've never seen before. They make those submersibles. And it's within this environment that Jeff went out to hire external counsel. He went to hire a law firm to help him, to give him counsel. And he was unwilling to hire a firm that would not give him a fixed price. And here's what he said to them. He said, look, my company makes things that cost millions of dollars. We have to be able to do it in a way that says to the customer, this is how much it's going to cost, and we guarantee it for this long. And we're talking decades. So he says, don't talk to me about not being able to manage risk. He goes, we can do it in our business. All I'm asking you to do is give me a fixed price and a scope for a certain amount of work. And so that interview was actually with Jeff and the counsel he hired, who was Patrick Lamb from Valorum Law. And so it's a dialogue between Jeff and Patrick and myself about this situation. And I think the context there very much applies to what accountants are in. And so I would encourage you to go listen to that episode. When I get a chance here, I'll look up the number and I'll mention it. But it's within that context of you're the professional. You need to be able to give a fixed price. Giving a fixed price is one sign of confidence. It's one sign of experience. It's one sign of, I got your back. All of those things communicate, we're going to handle this risk. And most of the risk that accountants work with their customers on are not life and death situations. About the only person I've ever met in the accounting industry, I can think of two, and there's probably some more, but the two that I've met, one was I met someone from Cleveland. This was at Scaling New Heights last year. I met somebody who specialized in being a CFO when the company was about to go bankrupt. So she's was one of these individuals who, when the company's about to go under, you call her in, she kind of comes in, cleans it up, and she has a history of being able to take failing businesses and get them righted again. Kind of like, take a ship that's sinking with holes, patch the holes and get the ship floating and upright again. The other is, just people in bankruptcy, right? Actually thinking of one of my cousins. It's not an accountant, but a bankruptcy attorney. Those are the two situations where it's kind of life and death, but even bankruptcy, not so much. I mean, I think I'm not saying don't take risks serious, but sometimes what's really getting us is not risk, it's fear of risk. We should not be scared of risk because, as I said earlier, Drucker says that's where profit comes from. I don't know, I'm rambling, but
no, it's good. No,
I think we've hit on something.
Yeah, no, we absolutely did. So this one accountant that you met that does CFO work for a company that's about to go under, let's analyze that, okay? Any accountant that would hear that, hey, would you like to be my CFO? My company's about to go under. They would say, well, pay up front. I would probably say that may be my initial reaction. But I assume that that's not the case, though. I assume that she's doing, it was she, right? It was
a she.
Okay.
Yeah, I will. Since you asked, I'll just compliment on this. She told me about one situation where a customer considered hiring her, decided not because she was too expensive. They came back a year later and she was more expensive.
Right.
They were in more dire straits and she charged more.
Correct. The opportunity cost. But what I'm saying is, I'm sure that she takes some clients that have a high risk of not paying her. Okay, that's on the table. Okay, there's a possibility that the company will go under. There's no capital, you can't get paid. But also, I assume that she's smart enough to price it way above what an average accountant would price, because she is taking that risk. And if she's able to take that company from under to something, she will take a much bigger reward at the end, either a bigger pay or possibly equity. I know some folks that do it for a mixture between pay, equity, and a promise to pay and IOUs and stuff like that. But inherently in her business, out of 10 clients, maybe 8 go under. That's true. It is possible that is the truth. It's a high percentage that go under and don't pay her. But hopefully she has enough built in, whether it's equity or pay me after you become solvent type of thing, to be able to overcome that 8 out of 10, that 80% with those 2 clients that she is successful for. So there's an adage that says, and I don't know if somebody said it, I apologize that I'm not quoting them. They said there's no such thing as a bad risk. There's just a bad premium. And basically what that means in essence is that something could have a chance of 50-50 failure. Like you could take on a project that's a 50% chance you'll get paid. Well, all you need to do in order to overcome that 50-50 chance is to double the price, right? That way statistically speaking, the ones that fail don't pay you, the ones that don't fail pay you, and you break even, right? Assuming that we're working with those nice even numbers. So at the end of the day, there's no bad risk, there's only a bad premium. So you can be in business to have some skin in the game, to take some risks alongside with your client, but the upside, especially if you know how to price it right and you build the contingencies and all the stuff around your pricing, they could be much better than the reward. I mean, than that, or the reward can be much better than the risk, and that is okay. So that's one thing I wanted to say. The other piece I wanted to talk about, you were saying that you are a person that's an outsider, that even if they're asking you a non-accounting question, just the fact that you're an outsider with an objective point of view adds a lot of value. Let me give you a stat. Looking at the SBA website here, the Small Business Administration, there's 28 million small businesses in the United States. Out of those 28 million, 5 million have employees. That means 22 million people have no employees. That means they work for themselves. Maybe there are some that have partners, but for the most part, entrepreneurship, it's a very lonely thing, right? And for the most part, all the burdens, all the pains come on that one owner, on that person trying to get that business off the ground. Sometimes, and I got to tell you, and I spend sometimes an extra 30 minutes, an extra hour, an extra 2 hours that I have programmed just listening to the customer, just letting them vent, letting them tell you about the frustrations, letting them tell you about everything that they screwed up on, which you know why they screwed up because you know how not to do it. But let them tell you what they did and their experiences. And sometimes just that by itself is extremely valuable. Just being a companion to your client, it's super valuable. I can't tell you how many clients I have. And if you guys are watching, I really appreciate that, have so much confidence in me that they basically bring me in for like a 5-minute thing in QuickBooks. And then we spend all the 2 hours, them telling us just their anxiety about their employees or anxiety about, their wife butting into their business or not even being involved enough into the business, or the kids, not being productive enough. Things that you would think that that's not my role, that I'm supposed to be a business advisor, this and that. I'm only supposed to talk about numbers and metrics and financials and projections. And that's absolutely not true. Sometimes advisory, it's listening, right? It's just listening. And from that listening, and it should be, the theory says that you have 2 ears and 1 mouth. So just by mathematics, you should be listening 66.67% of times, right? Because 2 of your body parts are for listening and only 1 is for speaking. So just mathematics alone say that 66.67% of times you should be listening. Some folks say it's an 80-20 rule, right? Or 90-10, you should be listening this much. Because in that listening, in that long line of anxiety and explanations and questions and worrying, in there's a few nuggets of gold that you can say, this area I can help with, that area I can help with. Maybe I can't fix your fights with your partner because I'm not a mediator or a relationship person, right? But maybe inside that ramble about your challenges in your business, you spoke about there not being clarity around who takes what. Hey, I'm an accountant. Maybe I can help you draft, a schedule on how you guys pay each other. So sometimes in the words, right, in the anxiety, in the worries, in the tale of risk and reward the client gives you, there's tiny little pieces of wisdom you can grab and you can turn into an opportunity for advisory. So I would tell you, advisory is not all mechanics and spreadsheets and metrics and graphics and projections. It's not all that. Some of it is that, and some of it is necessary in order to impress the client or give support to your decisions or give support to your advice. But most of it is just being another human being, a fellow entrepreneur, a person that has the same worries with skin in the game. And that's why clients like skin in the game. They want you to price fixed. They want you to take the same risk they're taking because in the long run, that's what clients will respect the most. And at the end, that's what builds trust, I believe.
Your point about listening is dead on. In fact, I would argue that the first step in effective pricing is listening. The ability to listen to what the customer is saying, truly listen with the ability to try to hear what's not being said and then ask questions to probe deeper to learn about what's not being said. How do you gain the trust to do that? Well, it's by listening. How do you get paid to listen? Well, you need to price effectively so that you are able to spend the time. We talked about resource planning earlier. Well, part of resource planning for advisors is pricing high enough so that they do not have all of their capacity taken up with customers. They have, quote, extra time. They have planned for the ability to take a call from a customer and just be able to listen. One of the things that I think is the mark of a true advisor is, do you have an agreement with your customer where they pay to have access to you? Whether they use that access or not, but do they value you enough in a circumstance to go, you know what? I don't know what's coming, but I know that if something comes up that's unexpected, Hector's the one that I want to be able to reach because I want his input. This is a concept we've talked about over and over on the Art of Value show. And it's a sign of exactly what we're talking about. We're talking about advisors. I can't help but think historically, going back to the difference between, an accountant, in the Industrial Revolution versus an accountant now, right? An accountant back in the Industrial Revolution, you didn't really get to advise many people outside your local area, right? You were the accountant in town and the people you talk to. Now you have the ability to counsel people all over the world. I mean, what we're doing right now, this is how technology has made advisory work and consulting so much more effective and so much more capable. It's really astounding when you think about it. But again, we're just challenging accountants to go, look, you were never meant to be this conservative thing, this conservative person. You are not conservative by nature. I mean, you think about it. Business owners are risk takers. Who do business owners want advising them? Other risk takers. I don't want somebody advising me who's never taken a risk. And if you're totally wrapped up in compliance and conservative by nature, if all you do is spend your time, as I've joked with Greg Kite on my show some, what do accountants do? Well, they're accountant. If all you're doing is accountant, then you're not taking risk.
And, so some businesses are large enough that they have a council of advisors, right? And when they have a council of advisors, they probably want to bring the ultra conservative non-risk taker accountant to bring in that devil's advocate essence, and then bring maybe 6 or 7 other CEOs from similar companies inside that council to be the ones giving them the risk advice. So it's not always true that your role should always be a fellow risk taker, what Kirk is saying, but the reality is that 9 times out of 10, all those 28 million small businesses that I was talking about, 90% of them probably have one advisor, right? The one that they must visit once a year to do their taxes. So many small businesses can't afford an actual consultant. So many small businesses are so afraid to give up what they know that they're afraid of talking to a competitor or a fellow small business owner and sharing best practices and business secrets and know-how. So many small business owners don't even discuss it with their spouse. And what they do is just a big fight because, my spouse doesn't understand what I do and why I work so hard. Look, Exhibit A, okay? My wife loves me and supports me and she works with me, but she doesn't understand the marketing element of what I do, like the conversation piece and the video piece and the social media piece, because there's no money here. Kirk and I, we spent, 20, 30, 40 hours developing a podcast in which we talk and we give this away for free. And there's no money here. But the both of us are taking the risk. We are taking the risk that if we spend the time, share our knowledge with each other, learn from each other, someone will be listening. And then when it comes time for us to sell whatever services that we're doing, right? Whether it's me selling accounting advisory services or Kirk selling consulting services for pricing or consulting services for having a value-based business model, the stuff that Kirk's good at, that people won't think of anyone else but us. But we are taking that risk. We are taking the risk by giving up the opportunity cost to pick up another tax client, to pick up another database, design client, the stuff that Kirk does. We're taking that risk by developing ourselves and a community around something that we're passionate about. So what Kirk is saying, back in the day, accountants, consultants, they were very limited to their physical, geographic network. And, remember, it's not what you know, it's who you know. Hey, look, I think that whole equation is shifting. Who you know is a very small network, even for the most popular people. I think that what you know and showing off what you know in a public manner changes the equation to not who you know, who knows you for what you know. So part of the risk elements that we take, as accounting professionals, as IT professionals, cloud software programmers, whatever, the type of people that listen to our show, that whatever you're doing now that builds on the future is risk. And your customers need to see that you're doing that. And that's why so many small business owners are attracted to folks like me and Kirk that share what we know up front and are open book, completely open, because they know what they're getting. They know absolutely what they're getting. So I just wanted to throw a little bit of what we're saying to add it into context on what we are doing, right? Because we're not fluffing this. This is, we put this stuff to practice. And we strongly believe that we can build an army of accounting technology professionals that follow this philosophy, add more value to their clients, and makes the community and the industry itself stronger.
I think one question that accountants and bookkeepers, pretty much any business owner, should be asking themselves pretty much every morning, definitely every week, but I would say even every day. And it might even be two different questions, because what risk am I going to take this week is a bigger question than what risk am I going to take this day. But the idea of what risk am I going to take within, and then name the time period, I think is a very important question. And I think it's probably important to ask it in multiple time period contexts. We do it every year. Now, whether we follow through, that's a whole nother conversation. But, we're just coming off the heels of a new year, right? About a month out. And everybody kind of is reminded, hey, it's a new year. I need to set new goals. Well, what is setting a goal? Well, in one sense, it's asking the question, what risk do I want to take this year? Because if it's not a risk, I would say you're not stretching enough. But business owners should be asking the question, what risk am I taking? And so to bring that home to accountants, what risk are you going to take to move your business forward? What risk are you going to take in your next customer conversation? In other words, what question are you going to try to ask during the next conversation that you've never asked before? A customer who's been your customer for a year, what is a risk that you can take with them that maybe you have, quote, earned the right to take because of the rapport and the trust you've built that you couldn't do with a new customer? This idea of what is the risk I'm going to take in this situation, in this time period, I think is very huge. And instinctively, it was a question that I think accountants asked before all the compliance work. Because if we've already talked about, compliance work pulled accountants out of this advisory stuff. It actually made them more conservative. I wouldn't have thought of an accountant being a conservative person before, all the compliance stuff. Now, I wasn't alive then, but just if I try to put myself back in that time period, I wouldn't have thought of them being conservative. And I don't think accountants should be conservative when it comes to their small business clients.
That's right. Well, I think they should strike a balance. I think one of the things that the profession has earned a reputation for is the fact that we are highly ethical, highly ethical, full of integrity, and hopefully also transparent. And nowhere there is said the word conservative, but it is pretty much implied The other piece, it's kind of a strange one. There are accounting principles that we study in school, and one of them is literally conservatism. So conservatism in an accounting principle says that that we don't claim income unless we're 100% sure it is income. And it's kind of interesting because, see, accountants on the public accounting world are there to tell someone how much a company is worth, and a lot of it drives from the income or the sales. So when we're conservative, we assume it's not income unless we have all the proof to prove that the income is real. So there is a fine line, Kirk, where you can call yourself a business consultant and do that, but unfortunately, and I think it's baby steps. I also don't think it should be like that we always should be conservative. But I think there is a transformation that is happening right now that is reshaping the industry, is reshaping who we are. And one of those areas that's going to be shaken is, this whole concept of, are we taking enough risks? Are we being too conservative? Is our conservatism and low risk taking an asset to our clients, or is it in the long run a detriment? And that's, I think, is more of a question than a statement. And I think we should keep exploring this concept in this podcast.
Well, I think a topic for another time might be just continue this conversation, because the more I visit with professionals in the accounting space and the bookkeeping space, I agree with what you said earlier. They are conservative by nature, and I think they should be the exact opposite. Now, one thing I think came to mind during your previous comment is there may be an assumption that we need to call out, is the idea that maybe being conservative is doing the right thing and being a risk taker is doing the wrong thing. No, we're saying when it comes to the books of the business, of course, you don't want to treat something as income if it's not income, et cetera, right? That's part of your function. But we're talking about an advisory capacity. So can you have a professional who acts conservative in one role and then more taking risks in another? Certainly you can. And I think accountants have to play dual roles. But I want to call out this assumption that's even prevalent in movies and mainstream media, that somehow taking risks is wrong. It's not. I would actually advocate that not taking risks. In fact, I don't want to turn this into a Sunday school sermon, but there are parables in the Gospels that talk about the people that get rewarded are the risk takers. The people who are conservative are shunned. And we're not talking about political beliefs either. I don't want conservatism versus, liberal and all that. That's not what we're talking about. We're simply talking about, are you going to play it safe, or are you in some area going to effectively look at the future and say, here's an area where I think I can have an impact and I'm willing to risk succeeding or not in that area.
Right. Yeah, for sure. I believe that we should not conflate conservatism politically versus conservatism economically, and conservatism in terms of in the small business context. Conservatism in accounting simply means that we're independent, that we are highly incredulous, and we do a whole bunch of testing, and we get a lot of documentation to prove that something is right. We automatically are skeptic on everything. That's what conservatism is. And look, there's a place for that. And then there's a whole slew of folks that will probably make a living forever with that attitude. And I am totally 100% okay with that. And it's almost healthy for industry to have those groups of people. But the movement that Kirk and I are trying to lead is for the few folks that want to take the risk and take 2 steps forward and be okay with being a martyr. Like, we can screw this whole thing up. Be okay with being a martyr. But hey, if we don't screw it up, we're definitely going to reap the rewards big time, more than the average accountant would.
So I think what Hector says is he will be happy to be a martyr for you on your behalf.
I will be the martyr of the accounting industry.
All right, my friend. Well, we have been going back and forth on this for close to an hour. I think we're at about a point to wrap this up. Anything you want to kind of mention as we close? It's interesting. We started on the idea of what did accountants used to do, and it brings us back to what should accountants be doing now? What are your closing thoughts?
Well, my closing thoughts, first of all, Kirk, I'd like to thank you. This is our fourth episode that we do this. I believe that 1 + 1 = 3 now. So that actually basically disrupts all my formal training in accounting, right? Because in accounting, 1 + 1 will never equal 3. But I believe that when humans are involved, the numbers are an afterthought, really. I mean, if anything, numbers are something that we, humankind, we concocted, right? We built numbers and we made numbers a thing. Numbers are not real, right? Numbers are a concept in our mind that we make real. Now, mathematics have made incredible strides to society, so I don't want to knock that down. But I want to tell you that I think that what's valuable in business is conversations, is brainstorming, is venting, and idea generation from it. So I'll invite people to be part of the podcast by adding comments, maybe recommending some guest speakers, sharing this video, sharing these recordings, emailing Kirk, emailing me, adding ideas. And this is something that it's going to be much bigger than Kirk and I have thought of. We strongly believe in that. So that's my last words. And I don't want to tell anyone what they should be doing, but I would like to be provocative enough to give you some ideas on how you can run with them on your own. And hopefully if they're successful, let us know. So we're excited about helping change some of accountants and technology people's lives.
So I'm, as you know, one of the reasons Hector and I enjoy doing this is because we complement each other. We're not the same. I'll be happy to tell you what to do with a straight face. So just call me. If Hector has a problem with that, I'll be happy. Nobody ever accused me of not having an opinion and being loud about it. And in that vein, I'm going to close it by saying this. Put a comment or a question below. Where are we wrong? Call us out. If there's something we said you disagree with, call us out because we want to learn from you. Hector, I'll see you next week, brother.
I'll see you in a week, Kirk.